Kitco News special coverage of the Precious Metal Summit is brought to you by Nucor Gold.
We're back now with Tavi Costa, portfolio manager at Crescat Capital, and we'll be talking about the trades that you should be making this year. Welcome back to the show, Tavi.
Thanks for having me.
I preface that with trades people should be making because you are a good example of someone who's done very well. Your precious metals hedge fund outperformed the markets tremendously. It's up 176% since inception only 2 years ago. Over the last 2 years, gold has not performed that well. The stock market has not performed that well. The gold miners index has not performed that well. So how did you do it?
I think majority of the focus in precious metals has been mostly in production and development stories. And so you can find a lot of inefficiencies in exploration. So most of our capital has been deployed, I would say 90 investments that we made in exploration companies. You're able to find companies that are putting discovery holes. The market doesn't care. And essentially, you have this very large increase of probability that they're going to find discoveries. And you own 15 to 20% of stake on those companies. It's kind of like a hybrid VC model where you're really betting for big winners. And we've had a few big winners in our companies. And so it's been a very good couple years. I think there's a lot to be done. I think we're entering an exploration age for most precious metals companies where we're going to be finding a lot of new discoveries. And so working with a guy like Quinton, I think it's a capital trend, lack of capital in the space, but also a labor trend. It kind of reminds me of the 90s, early 90s when you had the beginning of the tech bubble, where there was a lot of folks that did not know how to discern good and bad investments in the technology space. And I think that's very similar to mining, even though mining is one of the oldest industries in the history. And so we've been able to deploy capital in those companies that we think are high quality targets as well for acquisitions. And it's been a good ride so far.
There's research that VCs pick winners only, I'm reading this particular report, 2.5% of the time.
Yeah.
But those 2.5%, if you get a home run, you'll do well, and that more than offset the losses on your other investments. Was that a model that more or less you could ascribe to?
I think that's kind of similar. However, I think the betting rates and the successful rate is much higher in a model like this because the market's so depressed. And so it's like you're buying winning lottery tickets. By no means, I mean, it's guarantee anything, but you're buying companies that are putting out results. So probabilistically, they're improving their probability of finding something, but the market doesn't care. The market goes up 20, 30% on the back of those results.
How many companies would you have to pick to feel comfortable that your batting average is high enough? I mean, let's take your lottery example. I think Lotto 649 is 1 in 14 million. In theory, if I bought 14 million tickets, there's a 100% chance of winning, right?
Let's step back. There's about 2,500 companies in the mining space today, okay? A lot of them are actually exploration assets that are not going anywhere. They're either a company that bought a property, they have mineral rights for that property, they haven't found anything. So there's a lot of losers in that space. So you have to be very selective. But it's incredible. I mean, I've never seen a time when you can find companies that have discovery holes, still trading sub 20, 30 million market cap. You can come up and buy 15, 20% of those companies and write it up as they continue to follow up on those exploration projects and finding more things. And so that, for me, that's really the goal is to be able to find things that we think are going to be big, are going to be economically viable, and also hopefully purchased by the majors. If not, we're going to take them to production at some point as well. So
you mentioned that there's a lot of inefficiencies in this space. I'll let you comment on that.
Well, majority of the capital made in this industry, so the billionaires of this industry actually made their money in exploration. So majority of the billionaires in precious metals industry and base metals made their money on acquiring a property and finding a discovery. And so you get through that Lassonde curve, that very early stage of the Lassonde curve. So you buy something at really cheap levels and you have that speculative turn as you find something. And so that's kind of the goal. We've been able to acquire things around in the surrounding areas of a great investment that we made. It's been a learning curve for myself, and I think working with Quinton Henney, which I think is one of the most intelligent guys in the space, and we take a probability approach. It's not every company is going to work. We're very much aware of that. But if one company works very well, it makes up for the whole year. But it wasn't the case. We had more than one. We had a few of companies that actually put out really great results and are on to what we think are major discoveries. We think about 1/3 of the companies we own are probably on to major discoveries right now.
I actually interviewed Eugene Fama, who was famous for his efficient market hypothesis not too long ago. And his theory was that markets are always perfectly efficient at all times. Yeah. What have you done, your fund done, that differentiated yourself from other funds and such that you learned something about this industry that obviously maybe a competing investor did not learn about, hence your outperformance? You've demonstrated some sort of inefficiency. What is it that you've done?
I think it's just the fact that there's, as I said, a lack of labor in the space. If you look at enrollment for geosciences on undergrad and graduate students, for instance, it's been in a secular decline. So the interest for geology is low. Nobody wants to work as a geologist. And so that it usually reflects in markets. And so you have those crazy inefficiencies where people just don't care. It's hard to find jobs. It's hard to find a person that is actually willing to explore. How many young guys you know that are exploring out there? I mean, it's very few guys.
Not a lot of young guys at this conference.
Not really. Most of them are older. It's this very, it's a very actually narrow amount of folks that are actually young doing this. So I think that's really what we've been doing. But it doesn't mean it's an easy strategy. I think you have to, structurally, you have to be able to, today markets are so depressed, you're able to get warrants, you're able to get discounts through private placements and so forth. So it's been a good ride so far, but I think there's a lot more to be done. I wish I had more capital put to work because I think there's no shortage of opportunities.
I want to come back to your investment outlook towards the end of the interview. And I want to pivot a little bit more into macro now. But first, let's talk about your long-short strategy. So if I understand correctly, your hedge fund was long some things, short some things. Yeah. Can you break down what those sectors were?
Yeah, we're basically trying to replicate this idea of being long commodities and short equities, short financial assets, short anything that we think it's extremely expensive. And so most of the things that we're finding on the value side has been a natural resource. So we own a big chunk of inflation assets, meaning those are the precious metals strategy, as I said, base metals as well, energy companies, fertilizers, agricultural commodities. That's our long play. We also own assets in Brazil. And then on the other side, we hedge that by being short the markets, things that we think are the most expensive. So in 2021, we're short software stocks, even some other more popular, even crypto-related names. Now in 2022, we flipped that more towards consumer discretionary, large balance sheets, and also mega cap companies. I think mega cap is still, most of mega cap companies are still trading at 25, 30 times earnings, and some of those in free cash flow as well. And that's usually a multiple of growth. That's not my view.
Can you elaborate a bit more on the inflation hedging assets? A lot of people would like to know.
Oh, it's a mix of commodities in our opinion. I think there's a lot of macro trends that are going to be unleashed here because of the macro environment that we are in. Yeah. And so we're going to see a lot of things. I think it's a value versus growth transition, but also it's going to be related to things like, I think precious metals could do very well. I think owning tangible things, I think owning precious base metals is going to be a very interesting investment. I think agricultural commodities have a shorter cycle than other things, but it's going to be interesting as well, so we stay more liquid. Energy, I've never seen so many opportunities. Energy companies still trading at very cheap multiples despite this move that we've had in 2021 and this year. And so you're still able to find companies trading at 10, 11, 15% free cash flow yield, paying 15% dividend. That's nuts. And on top of it, so to me, it's one of the, it's another way to express the same idea by being long tangible assets. But
okay, inflation. Then let's talk about inflation. That would be a perfect pivot to our more high-level macro talk. CPI numbers came out yesterday. We're speaking today on Wednesday. It came out yesterday on Tuesday. Headline CPI dropped a little bit from 8.3% to 8.1% on an annualized basis. Actually, core CPI, which strips out energy and food, that actually increased in the United States up to 6.1%, I believe. And so it's interesting because oil, energy, like you mentioned, was a large contributor to headline CPI rising in the prior months. It's come down a little bit, which is why headline inflation came down. But if you strip energy out and food out, core CPI actually went up. How are you reading inflation?
Inflation is extremely entrenched in the economy today. I view it as four pillars of inflation that I call. It's wages and salaries growth, like we saw in the 70s. It's the chronic underinvestments in natural resources. It's the second pillar of inflation that is caused by, either extreme conservatism by management or ESG policies, political effort against those companies to spend money. Number three, the third pillar has to do with the reckless amount of fiscal spending. That back in the 60s and 70s, I would say most policymakers are pretty much aware that fiscal spending used to cause inflation. Not today. We're seeing a very extensive, I would say, political agenda right now. Peak inequality, green agenda. You have this infrastructure development idea. So there's a lot of things going on. And the fourth pillar, which I think it's the most important one, has to do with the deglobalization environment that we're in. I think that that's the beginning of a trend, not the end of one. Like back in the mid-40s, at the end of the World War II, that was the end of a deglobalized world. This is not where we are today. I think we're at the beginning of a deglobalized world, which is going to force most developed economies to actually reduce their reliability from places like China, which is going to have impacts on FX, but also it's going to actually create demand for commodities in order to rebuild their whole manufacturing plants here in developed economies. So we're going to see changes in I would say, currencies. I think currencies are going to trade different. We're going to see changes in correlations, like we're seeing treasuries declining and gold rising. We're going to see changes of powers, like emerging markets that are commodity-led economies do well. So there's going to be a lot of trends that are going to be unleashed because of that.
All right, the BLS broke down exactly what went up and what went down, and stripping away energy. A lot of people were telling me in prior conversations, energy was a big fundamental contributor to inflation. Sure, but this month's data proved that even if energy came down, other things went up. So these are some of the things. The BLS said that the index for all items less food and energy rose 0.6% in August, a larger increase than in July. The indexes for shelter, medical care, household furnishings, operations, new vehicles, motor vehicle insurance, education were among those things. The things that came down, airline fares, communication, used cars and trucks. So what do you think contributed to the increase in prices of those consumer goods?
Well, it's all starts when businesses realize that when they start struggling and they're capable of raising prices of their goods and services in order to couple with that issue, that becomes a trend. It's like folks beginning to ask for higher salaries. It's very difficult to reverse those trends. That's why they usually tend to be very secular. Right. And so inflation is going to be probably we're going to see it through waves. I think just like the 70s, we saw 3 waves of inflation. But remember, after a while of inflation running in the system, you start seeing labor markets beginning to deteriorate. Why is that? Sure. And that has to do with the consumer. The consumer starts getting squeezed, and so companies start losing earnings as well. So it's another theme that I think it has to do with the stagflationary environment we're in. So consumers, in my view, are at a breaking point right now. If you want to get into that topic, but it's really mortgage. Sure. Yeah, mortgage rates are literally at highest level since '08. And then you have saving rates for most households today near historical lows. And you have wages not really outpacing, the wages growth is not outpacing inflation. And fourth, you see the consumer sentiment is collapsing as well. So the combination of those things should be extremely negative for corporate earnings, in my view. And as you see corporate earnings declining, that should lead to lower employment. And so I think we're yet to see that feed in the system, and I caution a lot of policymakers. I'm not a policymaker, but seems to me like they're looking at lagging indicators such as unemployment rates, which we all should know that those are very much lagging indicators. But I think it's coming. I think an increase in unemployment rates is inevitable.
My question to you, Tavi, is: do you think policymakers need to do anything to combat inflation right now? This is why I'm asking you this. Okay, just taking a look at this chart here. This is the inflation rate going back to all the way to the 1950s. Yeah. The shaded areas are ember-designated recessions, and only one recession that I can see did inflation rise during recession. That's 1975. Yeah. Okay, all other recessions saw inflation decline. If you were to assume this model holds, why does the Fed need to do anything? Inflation should decline naturally in this current recessionary environment, right?
Well, because those are I would say those are demand-driven types of recessions. And I think what's happening today is totally a supply problem. When you have natural resources, for instance, if I was a policymaker, I'll probably organize an institution, a government institution, to go after most of the companies that are going after natural resources to produce more and reduce this dislocation of lack of supply of things in general, and hopefully provide more capital and availability of credit for those to do those developments. Instead, we're seeing the opposite. We're seeing monetary tightening is actually doing quite the opposite with those companies. I mean, ask any company here in this conference how hard it has been to raise money. Whole market has been collapsing. It's making it even more difficult for companies to produce. Let me give you an example. Oil and gas rig counts contracted in the last 6 weeks for the first time since 2020. Production for oil is flat in the last couple months. No one is talking about this. I mean, these energy companies, at energy prices where they are, they should be ramping up production, but they're not. It's a pressure from shareholders. Companies are paying more dividends and buybacks than what they do on CapEx. And so it's sort of an insane world that we're in, which makes me believe that this trend for commodities is going to be longer than a lot of people believe. And this is usually already a secular trend. But I kind of think that this reversal from CapEx being at near record lows, it's going to take even longer to reverse.
It's a very interesting perspective. So let me just sum up and correct me if I'm wrong. What you're saying is the Federal Reserve needs to do the opposite of what they're doing, which is to actually be a little bit more accommodative now, encourage producers of any consumer goods or commodities to ramp up production, increase supply, and that should bring down inflation.
That's what I would do if I was a policymaker. Yes, I would certainly even give subsidies to companies that are doing the right thing, that are trying to alleviate the issue. I mean, this is why we're having this issue, is because we have a lack of natural resources. And so it's not like the US has a lack of natural resources in here. I mean, it's a very mineral rich area. But you have to think about other things, that ESG policies and so forth will create partnerships with other parts of the world because of those issues. So I think South America can be actually might see a very positive catalyst because of those things, like Brazil.
Interesting. Okay, well, let's not talk about hypotheticals now. Let's talk about reality, because the reality is the opposite of what we just discussed. Yeah. Jerome Powell is very dedicated and committed to fighting inflation. He's made that very clear at Jackson Hole just a few weeks ago. What do you think monetary policy, assuming they're on the path, if they stay on the path of hawkishness, what do you think that policy is going to do to A, inflation, and B, the economic growth outlook?
I think, first of all, it's going to absolutely kill demand. I mean, I don't think this economy can really handle this level of financial conditions tightening that way.
But Tavi, let me interrupt you, but the economy has seen much higher interest rates before. We don't have to go back that much longer to see that the Fed funds rate was 5%. Mm-hmm. The economy back then was fine.
Here's the issue, though. I think we're facing a trifecta of macro imbalances, and that those times we're not facing those issues. What is this? I think we're facing the debt problem of the 1940s. So you look at debt to GDP, it's not like those times, like you're saying. It was back in the 40s, you had to have the economy financially repressed because of the debt levels. Now, on top of it, you have a valuation problem like we saw in the 90s. So you have companies still trading at very, very hefty multiples. And on top of it, you got an inflation problem of the 70s. So those three macro imbalances create, in my view, major political constraints when it comes to fighting inflation. And I don't think the economy can really handle what we're doing. Think about this. I mean, NASDAQ is down close to 30%, call it 30% from its peak, 25 to 30%. All last times in the last 20 to 30 years we had that. The Fed had to reverse their policy, either completely start expanding the balance sheet, slash rates to zero. That's the opposite we're seeing. They're raising rates by 75 basis points. On top of it, they're actually shrinking their balance sheet by $95 billion per month. If you look at global central banks, assets on their balance sheets, aggregate all of them, the ECB, BOJ, the Fed, what you find is that trends the NASDAQ very, very closely. And we just saw a decline of $3.5 trillion of basically liquidity. So liquidity is drying up. Things are still expensive. In my view, I think we're going to see a bigger decline in equity markets.
Okay, so let's talk about that. The NASDAQ fell 30% from its peak. We're going to potentially see lower levels for the stock markets. I want to come back to that. But Tavi, I want to ask you, how much of this 30% decline was due to Fed policy, Fed tightening? I ask this because I'm going to show you the effective Fed funds chart here. In prior tightening cycles, 2004, for example, spiked up several percentage points. 2016, for example, another several hundred basis points. In neither of those periods did the stock markets react this negatively.
Yeah.
In fact, if you remember, the stock markets kept going up throughout this decade.
Yeah, first of all, I think for the equity markets as somewhat priced in this duration risk. You're talking about the Fed funds rate. What about 10-year yields that are uncontrollably rising, which has nothing to do, some people are focused too much on the inflation camp.
Right.
What about the issuances of treasuries? We're seeing record amounts of issuances of long-dated treasuries today like we've never seen before.
Right.
300 billion or so being issued on the 10, 20, and 30-year treasuries today. That's creating a flood of issuances. And remember, the treasury market holds the keys for the equity markets in the global economy. You got 10-year yields rising. How do you discount a company now? Right? I mean, everything needs to be discounted differently.
Why was the 10-year yield rising?
I think it has to do with a major pressure of the supply of treasuries in general. We're not seeing the Fed being the largest buyer anymore. U.S. banks in the last 6 months are now net sellers, which is the first time in 3 years. So you start thinking, aggregate things, you look at what's happening in Russia and Ukraine, you think about China actually reducing the amounts of treasuries in their holdings. So who is buying treasuries right now? Right? Pension funds are facing this dilemma now where treasuries are declining. They hold a big chunk of treasuries and a big chunk of equities because that's the most popular way of portfolio positioning in the last 20 to 30 years. But things are changing. And I think we're seeing big changes in not only markets, but really correlations. And I think gold at some point is going to play a big role into being that kind of protector for or a defensive type of asset for pension funds and other larger institutions and capital allocators in general.
You have a number of very interesting slides. I like to go over slides.
Yeah.
Okay, so the first one, you briefly touched on this, consumer sentiment versus mortgage rates. This is fascinating. There's a huge divergence now as 30-year mortgage rates spike up to, I believe, 12 or 13-year highs. The highest it's been since 2008.
Yeah.
And consumer sentiment continues to decrease, not because of the rising mortgage, right? Because of a lot of other things. But what does this translate to the average? What does this mean for the average person living in America?
Well, the sector, consumer discretionary, it's having its worst year in 30 years. Have anybody talked about this? It's crazy. It's happening right now. The S&P, if you strip out consumer discretionary, worst year in 30 years. That's what it is. I think the consumer is getting absolutely squeezed. Remember, consumption is a major amount of the economy today. So it's hard to believe we're going to be, in a sustainably good place in 6 to 12 months from now. So,
well, give us a pair trade. S&P 500, which sector would you long, which sector would you short?
Well, I like most of the commodity related, natural resource related. So you can say energy would be one, you can say precious metals or base metal companies. That's literally what we have in our portfolio with that twist of exploration in precious metals and base metals.
Right.
Energy, we own the big guys. And fertilizers, we also own the big guys. On the short side, I still think that the mega cap has more, I guess, is the next shoe to drop. I think things like Apple, things like Microsoft are still very overvalued relative to what the markets are. And I also think consumer discretionary has more to go to the downside as well. Bigger companies that have big balance sheets, I think they're the ones that are probably going to face some big issues here. So, yeah.
What about defensive stocks like consumer staples? I'm just going to cite what happened in 2008. Walmart actually went up 20%, 2008 to 2009. Do you think this sector could see good performance?
Perhaps. I mean, it's not like they're very cheap companies either. That's the issue with equity markets is broadly things are expensive. But we have our own biases because we had 10 plus years of a bull market. We think every time we have a pullback, it's time to be buying stocks again. But I think this is a change in a regime here because cost of capital is rising. It's going to be more difficult to justify multiples. And things are going to be more difficult going forward. So you have to be more selective. I don't think this is an environment where you want to be buying the dip in most of those companies in consumer discretionary, technology. I think there's more downside. To answer your question, I think utilities are expensive still. There's maybe some green energy investments that are helping some of those names. We're not involved with some of those shorts. We get into shorts with utilities every now and then because they usually tend to be proxies with 10-year yields. So 10-year yields rise, utilities tend to get hurt as well. But that's not, I would say it's a very small percentage of our portfolio, so it's not really real focus.
I want to ask you about this slide here because we're talking about the tech sector. You brought it up. This one's called Tech Bubble, Non-Farm Payrolls versus S&P 500. You've got the S&P 500 index in the white line on the top, and then you've got a bar chart showing U.S. employees with non-farm payrolls on a month-to-month change basis. What is this relationship supposed to show?
Well, I think it's putting into perspective what happened during the tech bubble, because in the tech bubble, there was an increase in on-farm payrolls, close to 500K payrolls at that time, which was actually right at the peak of the tech bubble. And that goes to show how labor markets, most gauges for labor markets, indices in general, are lagging indicators. And the biggest contrary, I guess, or argument that I get from my thesis is that, Tavi, are you not seeing that unemployment rates are near historical lows and so forth? Well, that's all lagging indicators. And so I think you need to be looking at the margin. Like job openings are starting to decline from very large levels, but they're starting to decline in a big way. One of the largest declines we've seen since 2020 crash and since the global financial crisis. And so I think you need to be paying attention. Initial jobless claims is starting to rise. So those are, I think, on the margin and start. Look at the number of layoffs we're hearing all the time from major companies. That's still yet to fit into the labor numbers. Yeah.
Okay, well, that's not looking great for the corporate side. So finally, Tavi, you've got more or less bearish sentiment on the overall index. Is there a level of the S&P 500 that would make sense to you, at which point you would say, all right, it's fallen enough, it's time to get back in?
Well, yes. I mean, I'm happy to change my view if things get cheap. I think...
How cheap?
The way we look at things is not one metric. I mean, we looked at least 15 different value metrics. We're value investors at the end of the day, so we looked at a lot of value metrics. If I look at EV to free cash flow, if I looked at CAPE ratios, if I look at PE ratios, if I look at price to earning, price to sales, all those things are still frothy in most parts of the markets. But like, let's say mining industry. The mining industry right now, PE ratio is at the lowest level since '08 on PE. And so that's a very drastic, I would say a major difference from where equity markets are right now.
So what you're saying is, let's say the S&P 500 drops another 25% to 3,000 points, but the PE ratio is still high, you would still stay out?
No, that's one metric. There's 15 metrics I would look at. If most of those metrics are now at historical lows, I would be a buyer. Okay. I don't think we're there. And I think we're entering an environment where we're going from major liquidity, excess liquidity driven by central banks, to now a focus on price stability. And that's not a liquidity excess environment.
Again, I know the PE is just one metric that you look at in terms of valuations, but I would like to point out that it's been falling over the last couple of months. Is this an indication that perhaps valuations are improving?
Well, one of the biggest things that causes PE ratios to drop is that earnings have not dropped at all much. I mean, earnings are still at peak levels yet. So we haven't yet seen that decline. So I think we're yet to see the decline in earnings. Peak margins, I mean, margins are still very near their peak for most companies. And so I think we're still yet to see that fundamental weakness really. And I think prices are ahead of that, right? I mean, that's why prices are declining, because you're seeing that earnings are not going to be as good as they have been in the prior years.
Okay, final question, I'll let you go. You are heavy in the mining space. What are miners doing right now to maintain their margins, given that, let's take gold, for example. Gold has been flat, but inflation has been rising. I assume that their margins have been contracting, no?
It's been brutal. I mean, you just look at developers, especially, so exploration developers, producers. Developers have been crushed. I think there's probably one of the cheapest parts of the markets right now. I didn't used to think that way because I'm mostly focused on exploration. But I've never seen companies that actually have resources and so forth and de-risking most of their projects already, and they're still trading at very, very low multiples. But it makes sense, right? I mean, the cost of building a mine a year ago, it's up, double, right? And so they should be down significantly. But now it's getting to a kind of, I would say, a too extreme type of price environment. So I think it might be a buying opportunity. To your point, I think companies don't have a lot of, that kind of buying power like you're saying. I think, you need metals to move. I mean, we haven't seen that.
If I were an exploration company, and let's suppose that a senior or somebody is interested in buying me out in a few years, in a few years' time, I would say to my potential partner, my capex for this mine was double what it used to be, therefore I'm expecting a huge premium on NAV. Do you think that's going to happen?
No, I think what's happening here is that in order to kind of trigger the M&A activity like we used to have in other parts of the market, it has to come with stock prices of the majors moving higher, because that's their currency, right? For them to issue stocks and then buy those companies, they need to have a stronger currency. They need to have a higher price of their shares. And so we haven't seen that yet. And by the way, I think I said this the other day, but in my view, what's happening here, We need to see some sort of a new discovery, something that really drives attention to the sector. The mining sector is basically dead. I mean, there's not a lot of people really focusing here into the space. I think some funds are starting to get more attractive because of the value proposition. Companies trading at very low multiples, paying dividends. Look at Newmont's paying dividends. I mean, it's like high dividend yields relative to its history. And some of those are paying more dividends than utility companies. Why do you buy utilities? Because they pay dividends as well. They're defensive stocks. Mining companies are paying better dividends than that. It's a supplementary part of the thesis. It's not the main. It's not why you buy Barrick or Newmont, but it's a nice aspect of it too. And so I think they're really trying hard to attract capital. There's so many things, David, when you think about it. I mean, this value to growth transition, I mean, this is right in the middle of it, right?
What does Newmont need to do to realize higher shareholder value besides just waiting for the gold price to go up?
If I was a mining company right now, especially the mining companies that are producing and being able to generate free cash flow, and I track them very close, the top 5 and top 10 companies are producing or generating enough free cash flow, I would be buying exploration companies. I would be trying to buy some developers. I would be busy. I would be definitely, look, our portfolio, right? The way we looked at our portfolio right now is we have more drills turning in greenfield projects than Newmont and Barrick combined. They're not even drilling. They're not even going, being aggressively drilling to look for new things. And so
Newmont, well, they don't need to. They just buy juniors, no?
Well, they could do that as well. But historically, if I was a major company, I would certainly be drilling in new places as well. Yes, I would do that. I would be buying up some of the very cheap.
You're probably one of the few junior mining investors who said that. Most of them say to me, look, I would really prefer if the seniors just stay out of that game, leave greenfield or even brownfield exploration to the juniors and just focus on buyout.
That's fine. I don't want to bash on anybody else's strategy. I mean, that's a lot of ways to skin the cat here. Well, a lot of ways to make money. But I do think that's you should allocate part of your capital towards that. I think that's a part of the issue of the industry. I mean, most investors have been pressuring management to be extremely conservative. So you're not seeing exploration budgets are declining. It's a secular decline. What does it mean? Well, if exploration budget is declining, then it causes discoveries of gold, silver, base metals to disappear. There are no new discoveries, and so
it's a vicious cycle. So guys, it's the investors' fault for causing inflation. We didn't put enough capital for exploration. Now there's no supply. I'm kidding. But Tavi, wonderful thoughts. Great to have you on the show as always. Thank you.
Thanks for having me.
Thank you for watching Kitco News. I'm David Lin.
Kitco News special coverage of the Precious Metal Summit is brought to you by Nucor Gold.